Hello, options traders. Welcome, everybody. Well, it's another rainy day here in South Florida, and I'm sure it is for anybody who lives here in Florida. But I thought I would take a little bit of time here and create another video to help all of you succeed with options trading. So today I want to introduce you to Heiken-Ashi candles, the trend spotting candles. And these candlestick patterns are built like traditional candles, but with some twists. And the benefit is that they'll help you stay in positions longer. And when you can ride the trends longer, that's where the money's made. Now, I know a lot of people are going to hear, well, you can't go broke taking profits, which is what leads many traders to get in and get out quickly. And it sounds like it makes sense to close a position at the first sign of profits, but it's a mathematical disaster waiting to happen. The reality is that you can and will go broke taking profits if they're always small. If you're always clipping, let's say, a $5 option for a 50-cent or a $1 profit, even though the annualized returns might look great, it's only a matter of time before that stock gaps down and you lose 100% on the option. And when that happens, now you've got to make 15 or 20 trades successfully just to get your money back. And what's worse, this sets off a psychological trap. While trying to climb your way out of this hole, you'll want to take smaller and smaller profits. You get so fearful of taking losses that now you're going to take a 30, 40, 50-cent profit just trying to kick and claw your way back out. And then what happens? Stock gaps down again and you're hit with another large loss. It's only a matter of time. And that's why professional traders refer to this idea of taking quick profits as picking up nickels in front of steamrollers. Just because you may have been successful by getting in and getting out of a few trades doesn't mean the risk wasn't there. I might successfully walk across I-95 at night while wearing dark clothes and being blindfolded, but it doesn't mean it came without risk. That's the illusion that's created when traders get in and get out a few times successfully. They start believing that their system's going to continue to produce these profits. And I tell traders that if you've been successful so far, you haven't been doing it long enough. Keep taking small profits and you'll eventually see what happens. Now, I know that some people are going to say, well, it's been working great so far. Well, of course it has. We're in the second longest running bull market in history. But then that begs the question, why are you taking such small profits when such big ones are being presented? Now, another important point for staying in positions longer is that trends, whether up or down, last longer than traders expect. Remember, that's where the money's made. However, most traders don't know how to stay in position for long periods of time and capture those profits. Instead, with each passing day, they get a little more fearful that they're going to possibly lose that gain that they have, and so they close it out. But if you think about it, it really doesn't make any sense. It doesn't change the risk. Just because you open a new trade doesn't mean that you suddenly have eliminated the risk. You're still in the stock market, maybe under a different ticker symbol, but just because you close out a trade successfully has no bearing whatsoever on what's going to occur on the next trade. Instead, if you're in a trade that's working for you, run with it. Ride those profits, but instead hedge, roll, morph, do trade adjustments to lock in some gains, but stay in those trends. And that's exactly why Wall Street came up with one of its best adages, is to cut your losses short and let your profits run. But how can you do that? Well, again, the best way is to use options because professional traders know how to do those things I just talked about. Hedging, rolling, morphing, doing trade adjustments that allow you to stay in that position. And by staying in that position longer, you can ride that trend, but instead of just riding it blindly and hoping that it continues, you are continually scraping off profits off the table, but staying in that position. Does this mean that it's always going to produce gains? Well, of course not. But when they do pay off, they pay off big, and that's the difference. And when they don't, your losses are held small. It's exactly the opposite of what the get in and get out traders can expect. So let's take a look at what Heiken-Ashi candles are all about and how they can help you. First of all, this is derived from Japanese. That is exactly where the candles first originated. And it translates loosely into average leg or average pace. And it's a type of an averaging method that uses traditional candlesticks, but with a twist. And that twist is that it uses averages, not in all cases, but in a lot of cases. So let's do a quick review of a traditional candlestick pattern, and then I'll show you how the Heiken-Ashis differ. So I showed this in a previous video, but remember, a traditional candlestick pattern is going to look at the open, high, low, close. So if the stock opens at 100, that's the opening trade. If it trades up to a high of 105, that would be our high. Maybe it trades as low as 98 during the day, and it finally closes at 103. Those are your 4 key data points: open, high, low, close. And in this example, because the close was above the open, they create a box between those two, and they're going to shade it green to indicate a positive day. The closing price was greater than the open. And then they create these little shadows, or what some people now call wicks, to connect to the high and the low. So that's what your candle would look like. If it was reversed and the close was below the open, same idea, you would just have a red candle. If you happen to be looking at your candles intraday and the market's not closed, then the current stock price will be taking place of that close. But once that final bell rings, then you're going to lock in your candle into this open, high, low, close formation. So how does Heiken-Ashi differ? Well, there's a couple of key definitions that you have to understand. And first of all, don't get too wrapped up into the math that I'm about to show you. The computer does it for you. I just want to show you what's going on. First of all, the opening price is an average of the previous day's Heiken-Ashi open and close. The closing price is the average of today's open, high, low, close. So for example, let's say that this is our candle right here. We opened at 100, we closed at 102, we had some highs and lows in here, and this is, let's just say, is a Heiken-Ashi candle, which means we've been using Heiken-Ashi for a while. The reason I mention that is that your very first Heiken-Ashi candle has to be built from a traditional candle, so it uses all of the same data points with the exception of the closing price. But once your chart's up and running, second, third, fourth day, you're just looking at only Heiken-Ashi candles. So again, let's just assume that this is a Heiken-Ashi candle, and let's just say it was from Monday, from yesterday. And today, on Tuesday, we get an opening price of 104, high trade of 107, low of 99, and a closing price of 100. These 4 points would be used to create a traditional candle. However, the Heiken-Ashi is going to put a twist on it. The Heiken-Ashi candle is going to open at the average price between the open and close of yesterday's Heiken-Ashi candle. So if we opened at 100, closed at 102, the average is 101. Just add those two numbers up, divide by 2, that's your opening trade. First important point, notice that this price right here is exactly centered of the previous day's candle body. And that will be true. That's a unique characteristic of Heiken-Ashi. You'll never see gaps. You won't get these gap up and gap downs because the candles always line up at the center of that previous candle's body. Also notice that even though the Heiken-Ashi says the opening trade was 101, if you go and look at the actual data, you'll say, wait a minute, the opening trade was 104. And that's right. Heiken-Ashi is not always using actual data. It's contrived. It's using averages. You'll find out shortly it's not in 100% of the cases. It depends on what's happening with the highs and lows. But for right now, you're going to see that the opening trade is always an average. Next, how do we figure out the closing price for Heiken-Ashi? Remember, the definition says take the average of open, high, low, close from today's data. So if we take these 4 numbers up here, we add them up, divide by 4, the average is 102.50. And that will be the Heiken-Ashi close. Notice that even though the actual close you're going to see on your chart is going to show 100, or if you're looking at traditional candles, the Heiken-Ashi close is going to show 102.50. What will the high be? Here's what also gets a little tricky. Heiken-Ashi looks at 3 data points for the high. It's going to look at its current opening price, it's going to compare it to its closing price, and it's going to compare it to the actual high of today. And whatever is the highest of those 3 values gets recorded as the high price. So because out of these 3 prices, 107 is the highest, Heiken-Ashi is going to show 107. And that would exactly correspond to a traditional candle. So let's just make a little note down here. The Heiken-Ashi high will be 107. What about the low? The low does a similar calculation. It's going to always compare the Heiken-Ashi open to the Heiken-Ashi close, and then it's also going to take a peek at the actual low for today. And the lowest of those three values is 99. So Heiken-Ashi will record 99 as the low. So Heiken-Ashi is going to say the high was 107, the low was 99, and again, those 2 points will exactly correspond to the actual high and low you'll see on your stock platform and on your traditional candles, but it's not always going to be. Sometimes it's going to be the Heiken-Ashi open or the Heiken-Ashi close. Just depends on if those are the actual highs and lows for that particular day. So your Heiken-Ashi candle is going to look like this. It's going to show an open of 101. It's going to show a close of 102.50. That's the average of these 4 numbers. So here's 102, like 102.50 up in here would be the close, and it's going to connect that body right there. And of course, because the close is above the open, it will shade that candle in green. And then it's going to say what was the high. It's going to trace a shadow up here to 107, and it's going to say the low was down here at 99. And that's what your Heiken-Ashi candle would look like. So here's a chart, a traditional candle of NVIDIA. Now the first thing, notice that as with most traditional charts, you get kind of a alternating reds and greens. You get a few red candles, few green candles, back and forth. You'll see some gaps, these little spaces in here, gap ups. You'll also see gap downs like we see down here. You'll never see that with a Heiken-Ashi because by definition, the candle always opens dead center of the previous day's candle. But because of the averaging method of Heiken-Ashi, it's going to show much longer trends, what the average prices were doing instead of the instantaneous day up and down. So it's a little easier to get lost into what's the trend when you see these alternating red and green candles. But watch what happens when we switch over to Heiken-Ashi. Now most platforms allow you to change this. I'm going to come up here to display, and you can see that I'm set to traditional candle, and right down here I have Heiken-Ashi. Quite a different picture. Look at how long these streaks of green are. Long streaks of red, long streaks of green through here. You don't get that, again, that traditional kind of oscillating couple of greens up, couple of greens down. You tend to get longer streaks. There are some other interpretations we can look at here, such as over here when you see these shaved bottoms, usually called a Morobozu candle. That is a very strong upward trend. Very few lower shadows except up in here, but very strong trend through here. There's no reason in the world to close that position through here. You definitely want to be rolling through here. Look at the red candles over here. Opposite. Shaved candles on the high side, opening trade, very strong selling pressure through here. No reason to close the short positions in here. Instead, you want to roll them. There are some patterns between traditional candles and Heiken-Ashi that overlap, such as with dojis. But for the most part, when you're looking at Heiken-Ashi candles, you're not going to get the very common formations like a bullish and bearish engulfing. You're not going to get the shooting stars and the abandoned babies and the hammers and all of these other types of formations that we get with traditional candles. Instead, you're going to get long periods of greens and reds. There are a few exceptions. Don't have time to go into it in this video, but the main thing I want to see people do, especially if you're new to trading, is to try to stay in the positions longer. Trust me, the last thing you want to do is to get in and get out. That's a losing game. I'll do a video here sometime in the future and show you why mathematically that cannot work. But for right now, just try to change your thinking into stay into the position, hedge the risk. And the way you do that is to hedge, roll, morph, and do trade adjustments as things change. And Heiken-Ashi candles can show you a much clearer picture of when things are about to change. And for those who'd like to know more about the art and science of strategies, you can check out Strategy Lab at optionszz.com. You can also instant message me here in Facebook.